£2,800. That is what HMRC took from a man I sat with last month. One pension withdrawal, one emergency tax code. He was owed almost every penny back. He had no idea. And nobody at HMRC was going to ring him to explain it. There are 8 things HMRC expects you to complete the moment you stop work. None of them will arrive in a letter. I spent 29 years inside HMRC, 8 of those in the Pensions and Investments Compliance Unit, then as a senior investigator, then on the team that wrote the guidance inspectors used when the rules got complicated. I watched the system take money quietly from people who had earned it and assumed the rules were on their side. I'm not on the payroll anymore, which means I can say a few things I wasn't allowed to say before. 1. Tell HMRC you've stopped working. This sounds obvious. It is not. When you were working, PAYE handled everything. The day you stop, that system stops with you. No replacement instructions arrive. HMRC does not update your tax code automatically when you retire. And here's the bit nobody explains. Your state pension is taxable income, but it is paid gross. No tax is deducted at source. HMRC collects what you owe on it by quietly reducing the code on your private pension instead. Get the starting picture wrong and you overpay every month, or build an underpayment that arrives as a January bill. Both are avoidable. Only you can fix them. I sat with a man I'll call Norman at Citizens Advice, 64 years old, retired in April and assumed the system had updated itself. By October, his code was still wrong. 6 months of overpayments. Over £900 sitting with HMRC that should have been in his account. I just assumed they knew, he told me. They don't. They wait for you. Don't be Norman. Ring HMRC on 03002003300. Say, I've recently retired. I want to make sure my tax code reflects all my pension income correctly so I'm not over or underpaying. Full reconciliation. Under 10 minutes. Free. Scotland. Scottish codes carry an S prefix, like S1257L. Same call, same number, different rates once corrected. 2. Open your personal tax account. Most retirees have never heard of it. Most have never been told it exists. It holds every tax code HMRC has issued, every statement, every letter, and your full national insurance record. All in one place. Free. And here's the bit nobody explains. Every HMRC deadline begins from the date on the letter, not from when you opened it. If post went to an old address, the clock was running. The personal tax account is the one place you can see everything HMRC holds about you, including letters you may never have physically received. I sat with a woman I'll call Patricia at a Pensionwise session, 67 years old. A simple assessment had arrived the previous summer at a house she had left 3 years earlier. She found out when HMRC's debt team wrote to her new address. The 60-day window to dispute the figures had already closed. The figure was wrong. She paid it anyway. £340 she did not owe. Why didn't someone tell me? I didn't have a good answer. Don't be Patricia. Go to gov.uk/personal-tax-account. National insurance number, a recent P60 or payslip, passport or driving license, 10 minutes. Free. Check it every April when new codes are issued. Scotland. Same URL, same process. Scottish rates appear against your S-prefixed code in the account. 3. Claim the state pension. This is the single biggest broken assumption I encounter in Pensionwise sessions every week. Let me say it plainly. Your state pension does not arrive automatically at state pension age. You claim it. And here's the bit nobody explains. The DWP sends an invitation letter roughly 4 months before your state pension age. There is a code on it. Do not act, and the pension defers. That can be deliberate. It should never be accidental. The full new state pension is £221.20 a week, £11,502 a year. You need 35 qualifying NI years for the full amount. 10 years is the minimum. I sat with a man I'll call Brian at Pensionwise last year. 66 years old. Reached state pension age the previous March and assumed the money would appear. It had not. He had planned his entire cash flow around income that was not coming, ringing his bank every Monday morning wondering where the payment was. The claim was backdated when he finally made it. 6 months of confusion and anxiety over money he had already earned. Don't be Brian. Claim at gov.uk/get-state-pension using the code from the letter. No letter, and within 3 months of state pension age. Ring the pension service on 08 007 317898. First payment within 5 weeks. Scotland. State pension is administered UK-wide by DWP. Same process, same number. 4. Reclaim the emergency tax on your first pension withdrawal. This is the one that made me genuinely angry when I was still inside the system. A foreseeable overcharge, a clear remedy, no connection between the two when it affects you. And here's the bit nobody explains. When you take your first flexible withdrawal from a defined contribution pension, a SIPP, a personal pension, a workplace DC scheme, your provider almost certainly does not hold your current tax code. They apply an emergency month 1 code that assumes you will take the same amount every month for the rest of the tax year. A one-off £10,000 withdrawal gets taxed as if you are drawing £120,000 annually. For someone with no other income that month, roughly £2,800 disappears. The actual liability is close to nothing. Nearly the full £2,800 is yours to reclaim. I worked in the unit that policed pensions tax for 8 years. We saw this every week. The rule creating the overcharge is on the books. The remedy is on the books. The letter accompanying the withdrawal mentions neither. The remedy is one of 3 forms. P55 if you took part of your pot and plan to take more. P50Z if you emptied it with no other income. P53Z if you emptied it but have taxable income such as a state pension. All 3 go through the personal tax account. Stated turnaround, 30 days. Do not leave that money sitting in an HMRC account. Scotland. Same forms, same process. Scottish rates affect the precise figure owed. Identical claim mechanism. 5. Stack your savings allowances. Most retirees know the £12,570 personal allowance. Very few know there are 2 more on top. Almost nobody has been told that in the right structure, you can hold £18,570 of income in a year without paying a penny of tax. And here's the bit nobody explains. 3 layers. Personal allowance, £12,570. Starting rate for savings, up to £5,000 at 0%, tapering by £1 for every £1 of non-savings income above the allowance. Gone once pension income reaches £17,570. Personal savings allowance, £1,000 for basic rate taxpayers, £500 for higher rate. Stack all 3 on a modest retirement income, and the total reaches £18,570 tax-free. And HMRC estimates your savings interest from last year's data. If you moved money into an ISA 12 months ago, your code may still penalize you for income you no longer receive. I sat with a woman called Eileen, 71, state pension of £11,000 and £600 of savings interest, total income, £11,600, tax bill, 0. 2 years of unnecessary overpayment because nobody had explained the stacking. Don't be Eileen. Ring 03-002-003300 and say, my savings interest is within my personal savings allowance and starting rate for savings. Please remove the savings income adjustment from my tax code. Scotland. The starting rate for savings applies UK-wide. Scottish rates apply to non-savings income only. 6. Claim Marriage Allowance, a decade available. HMRC's own estimate. 2.4 million eligible couples have never claimed it. The data exists. HMRC knows who qualifies. It does not write to those people. You have to ask. And here's the bit nobody explains. If one partner earns under £12,570 and the other is a basic rate taxpayer, under £50,270 in England, Wales, and Northern Ireland. The lower earner can transfer £1,260 of their personal allowance to the higher earner. That cuts the tax bill by up to £252 a year. Backdate 4 full years, and a first-time claim this tax year recovers up to £1,008 in backdated payments, plus £252 going forward. I sat with a couple I'll call Ray and Margaret, both 70. Ray's pension sat just above the personal allowance. Margaret had a small occupational pension and nothing else, below the allowance for 6 years. The refund was £1,008. Free. "Why did nobody tell us?" she said. 6 years of HMRC holding that data and saying nothing. I didn't have a good answer. Apply at gov.uk/marriage-allowance. The lower earner makes the claim, not the higher earner. That is the most common reason claims fail. Both national insurance numbers required. Warning: third-party companies in search results charge 30 to 50% of a refund you can claim yourself at no cost. Scotland. The higher earner threshold is £43,662 in Scotland, not £50,270. Process and form are otherwise identical. 7. Read the simple assessment before you pay it. Around 140,000 pensioners receive one every year. Most pay promptly. A meaningful number pay a figure that is wrong. And here's the bit nobody explains. If tax accumulates that PAYE cannot collect automatically, HMRC issues a simple assessment. The reference is PA 302. The figures are often estimates, savings interest in particular, taken from the bank's annual return, which does not always distinguish which account paid what, or whether savings moved into an ISA. The number can be wrong. You have exactly 60 days from the date on the letter, not from when you opened it, to dispute it. I sat with a man called Frank at Citizens Advice, 72 years old. His PA 302 arrived in August while he was abroad. Opened in September. 31 days gone. He checked every figure against his bank statements. HMRC had used an estimate from the year before he moved his savings into a cash ISA. Interest overstated by £4,200. Bill wrong by over £800. 29 days left when he rang. He made it, just. Don't be frank. Open it the day it arrives. When a PA 302 lands, check every figure against P60s, pension statements, and bank interest records. Anything wrong? Ring 03-002-003-300. Say, I have received a simple assessment reference PA 302. I believe a figure is incorrect, and I want to raise a formal dispute within the 60-day window. Scotland. The PA 302 process applies UK-wide. Check Scottish income tax rates have been applied correctly. 8. Start the inheritance tax conversation. This year, from April 6, 2027, unused DC pensions will be brought inside the inheritance tax estate. That ends a rule in place since 2015. The deadline is 11 months away. And here's the bit nobody explains. A married couple can currently pass up to £1 million to their children free of inheritance tax using nil rate bands and the residence allowance. Above that threshold, 40% goes to HMRC. From next April, unspent DC pensions sit inside that calculation for the first time. A SIPP worth £300,000 that today passes to children free of tax will, if the estate has consumed its threshold, generate a bill of £120,000, where today there is none. The spousal exemption survives. Pensions to a surviving spouse remain exempt after April 2027. The second death, pensions to children, is where it bites hardest. I sat with David and Christine at Pensionwise this year, both 68. ASIPP worth £285,000, untouched for a decade on consistent advice. Pensions sit outside the estate. We thought the pension was the safe one, Christine said. It was, until April 2027. Don't be David and Christine still sitting on this in March 2027. Ring your pension provider. Say, I'd like to update my expression of wish on this pension. Can you tell me how? 20 minutes. Free. Then ask a qualified financial advisor. How do the April 2027 pension IHT rules affect our estate? This year is the year to have it. Scotland. Inheritance tax is UK-wide. Same rates, thresholds, and April 2027 changes apply in Scotland. The system runs on what you ask for, not on what you're owed. Tell HMRC you've retired. Open the personal tax account this week. Claim the state pension when the letter arrives. Reclaim the emergency tax with the correct form. Stack your savings allowances. Claim marriage allowance and backdate it. Open the simple assessment the day it arrives. Start the inheritance tax conversation now. That is where we started. £2,800. One emergency code. One man who did not know the remedy was 15 minutes and a 30-day wait. 800,000 retirees face this every year. Most never claim it back. These are not loopholes. They are the rules. PAYE handled them in the background while you were in employment. Now you handle them. HMRC just does not ring to tell you what they are. The wills, the nomination forms, the allowances, none of it is complicated. It is paperwork. But paperwork left undone is what HMRC quietly relies on. Take care of yourselves, and take care of your money. I should say, as I always do, nearly 30 years inside HMRC, and now a citizen's advice volunteer. Nothing here is regulated financial advice. For your circumstances, particularly pensions or inheritance tax, speak with a qualified independent financial advisor. Book a free Pensionwise appointment if you hold a defined contribution pension. Number 0800113797. All links are in the description.